Good morning, Brian. How you doing?
Doing great. How are you, Ryan?
Doing good. You and I are both stuck in Minnesota where it is snowing and we're both locked up. And I think this is a good time to have a nice conversation that we're about to have. And I'm excited to have you on the show because you've got a lot of specialty background that I want to kind of pick apart, because the 1031 exchange is something that a lot of business owners have heard about, maybe not had as much information that they wish they would have. But before we really dive into that, can you go back and, you and I were talking about it a little bit prior to you getting on, but give the listeners a little bit of a story on your background and then how you got into this market.
You bet. Well, thanks for having me this morning, Ryan. I'm excited to talk about this topic. I think that, there's a lot of misunderstanding about the 1031 exchange and the process. And so I welcome the opportunity to answer any questions and, provide a little clarity on really what's one of the best wealth building tools still available to us. So thanks again for the invite, and excited to talk about this. My background, as I was telling you earlier today, I went to school to be a professional. I was actually going to go to school to be a doctor, and went on to get a biology degree and go through the motions of being a doctor. And I decided that I'd be a much better real estate guy than a doctor. So much to my parents' amaze, I went back to school. And I've been in the commercial real estate industry for about 20 years now. And like I said, went back to school and got a finance degree to kind of better support what I was interested in doing.
How did you go from Petri dishes to real estate?
Yeah. Well, it's all a detailed process, right? And sometimes there's good things on that dish and sometimes there's not. So, our jobs as real estate guys are to find the good dishes to deal with. So I'll circle back that way. Yeah.
So was there something that, did you buy a piece of commercial real estate yourself to get into it? Or, what was it that intrigued you about the whole real estate market?
That's a great question. So I had kind of worked my way through college doing property management in office buildings. And so I really learned the business from the ground up, knowing, properties from really the base level to all the way through the investment process. So, and it's helped me in many instances where we'll be evaluating a replacement property for a client, and, we'll understand kind of the nuts and bolts of the deal because we've got that background. But really what attracted me to it was, it was kind of out of necessity. I needed to start investing in property. When I left school to be a doctor, of course, like most kids, I had a lot of student loan debt and needed to figure out a way to get rid of that. And so I started investing in single family homes. This was back in the mid 90s to late 90s. And it was a good time to be doing that because asset prices were relatively low for what you were getting. And then we had a nice run up in 04, 05, and I exited the single family home market in 2004. And it was, a good run for us. Took care of all that student loan debt and kind of launched my investment career, if you will. Well,
that's interesting because I think how you've progressed and grown in the real estate market is probably a good segue into the 1031 because of kind of the nature of the vehicle. But, let's start from the ground with the 1031 and maybe give, a background of what it is, where it came from, and kind of the main, overview before we kind of get into some of the applications of it.
You bet. And I think right before I get into that, I'll just to finish the background piece from the early 2000s to today. I really went into the investment segment then and helping others. I had done a pretty good job myself, but wanted to do more commercial assets. And commercial assets are defined as, industrial properties or big multifamily properties, apartment buildings, hotel properties or hospitality, retail buildings and office buildings. So those are kind of the food groups, if you will, of commercial. And I really enjoyed that process because that's kind of how I'd grown up in the industry and came back full circle as an investor. So from about the mid 2000s till current today, what we've been working on is helping other investors, get into property and putting investment partnerships together where we'll participate with our own equity as well. And alongside of that, there's typically a transaction that's happening. There's a sell side, or somebody says, I've had this building for 25 years. It served my business well, but I'm selling my business, or, that type of thing. And I want to go to Florida and have you send me a check. So what we decided to do is create a company where we could do that. We can help people with the disposition of the real estate, put it into a 1031 exchange, and then, manage the asset for them afterwards, so they can truly be hands-off investors and passive investors. And the way that process works, Ryan, is, first you got to identify the use. What's the property being used for now? And this is where people get a little confused. Let's say you've got a guy that had a manufacturing business and worked hard all of his life, family business, maybe it was even multi-generational, but it's not being handed down to the next generation. So they're doing an outright sale because it's a good time to do that. But they've got all this real estate that helps support their manufacturing business. Well, the IRS allows you to do a like property, like kind exchange, which like kind exchange doesn't just mean, industrial property in this example for industrial property. It can mean industrial property for multifamily property, or industrial property for a hotel property. So, the property use is a little less important than people think, because it really, a like kind exchange is, business property for business use.
Well, I was going to say that was actually going to be one of my main questions, because, I think that's where, where does the border go around it? Is it mainly just the asset class of real estate, or is it, or business functionality? But because I think there's a lot of different ambiguity of, where does that start and stop?
Yeah. And, with all of this, it's always smart, I'll put the little disclaimer out there. It's always smart to consult your tax attorney and your CPA. And, and I'm part of the team. Typically, I always require that my investors are working with a team, and I help them on the real estate side of it. But we also have, always an attorney and a tax accountant involved to make sure that we do it properly. So I'll throw that out there. But really, it does border around real estate assets. Even residential can be thrown in there, although most of my clients are at a stage where they're not, residential is usually the first step kind of in an investment process. So most of our clients are at a stage where they're wanting an apartment building or a hotel or something that will produce enough income in retirement that, they can enjoy their retirement. But, the real holding period is a little gray in 1031 exchange. The IRS has basically said, as long as you hold the property generally for 1 year and a day, you can sell it in exchange. So we do have, and it needs to be defined as held for investment purposes. So let's say, again, that example of the business owner that had the property. He probably had it set up in a separate LLC that his business was paying. So it wasn't for investment purposes. Typically, that's how we see it done. And so you're just exchanging for another building that's, held for investment purposes.
Interesting. Well, I think we can kind of tie that back into kind of some of the applications too, because there's so many stories about how to actually go through it. So going back to, the transaction that's happening, and you've identified the use of it. So what exactly is the functioning, and how does it play into that whole transaction once you've determined the use?
Yeah. So one of the members of the team is called a qualified intermediary, a QI. And there's many people that can serve as a qualified intermediary. I am not a qualified intermediary. I more serve as the acquisition guy and the asset manager guy afterwards. But one of your team members would be a QI. And that's basically an IRS mandate that, you use an independent QI to the transaction, and they prepare the legal documents for the exchange. And so very reasonably done. We use a firm, that's been in business a long time, does hundreds of these transactions every year. And the first thing we like to do with our clients is get them set up with the qualified intermediary. And what that means is when you sell your property as part of your transaction, your funds actually get parked with that qualified intermediary. You can't accept the funds at closing, or else the IRS will say, hey, you realized a gain and we're going to tax you on that. So you have to park those funds with a qualified intermediary. When you do that, it's a short timeline. So you have to be ready, and your team's got to be ready to do this. So people always say, how soon should I look at doing, planning for a 1031 exchange? And I say, like today, because this process, it can get really fast. And if you don't have the right team members and the right timeline in place, you're going to pay taxes. I mean, that's the worst case scenario, is you're going to pay those taxes you probably otherwise would have. So why not give yourself a shot, is what I say to our investors. So then what it does, when you close on your property transaction and you've got your team in place, the IRS says, okay, you have 45 days from the date you close for the sale of your properties to identify in writing with your qualified intermediary. And there's a couple different rules. There's one rule called the 3-property rule. And that rule and it's probably the most popular. I'd say 95% of our exchanges are done with the 3-property rule. And what that means is, again, back to that example of the industrial property. If he or she sells their property, and let's just pick a number. Let's say they sell it for $1 million. Mm-hmm. The IRS says, okay, you need to replace at least $1 million in property value with this exchange. Now, you can put that into up to 3 different properties. So you don't have to, you can kind of diversify. It's a great chance to do that. And about 95% of our exchanges are done that way. There's another rule called the 200% rule, where it doesn't matter how many properties you do, but the value has to equal at least 200% or more of that, in this example, $1 million. So
I was going to say that would be kind of difficult that's a lot of work trying to find that amount of property, right? That's 200% of the value, and especially diversifying. That's just, is that why that would be the lower of the, 95% are doing the 3 property versus doing the 200?
Yeah, great question. And that's really market driven. I haven't seen a 200% transaction in probably since the recession, and we had asset prices that were much lower. It kind of made sense for people to go out and diversify and buy a bunch of property. Mm-hmm. We're not in that world right now. Asset prices are fairly high, and you can still find value out there, but in a 45-day window, you want to be pretty focused on property type and
still trying to get a good deal. You're not, you want to get a good deal, even though you're avoiding taxes. You still don't want to just go overpay for something.
And that's a great point. And, I'm working with a client right now on a large transaction, and this is one of the most important steps of their lives. And we were talking the other day, and I said, look, if we can't find the right property during the ID period, I'm going to be the first one to tell you, don't do this. Let's pay the tax. That's the worst case scenario. We tried to identify and couldn't, we just didn't find the right fit for this particular client, because it comes back to a risk reward discussion. And, just like when people invest in stocks or bonds, real estate's the same way. What's your risk tolerance for the reward that you're going to get? And sometimes we can't find that right combination for people. And I'll be the first one to tell people, don't do this, because, it's better to pay the tax and start over than get yourself into a losing situation.
Especially in real estate when it's illiquid and it's not as fluid where you can, quickly diversify again.
Exactly. Yeah. So we are on that 45-day period. You've ID'd 3 properties. You're feeling good about this, right? You've got that $1 million gain that you're going to protect. And you're, by the way, protecting it from both federal and state income tax, which is a beautiful thing when you're in a higher tax state. So, you're going to take that full $1 million and put it to work versus, let's say, you decide to pay the tax and you're, in some states pay as much as 40-50% of your gain.
Yep.
It's why wouldn't you use this great wealth building tool that's, it's got a good process. So then, after you've ID'd those properties, you have 180 days, or basically 6 months, to close on the exchange. And what that means is, let's say you sell on, December 31st, by, the end of May, you are going to have closed on your replacement properties. So the process is pretty quick. That might not sound quick to people who haven't invested in commercial real estate before, but that is pretty quick. You have due diligence to perform. You have the 3 properties you're going to ID, and you're going to try to pick which one you really like and go after it. And so from day 45 to day, call it 120, I'm working with my clients to get property under purchase agreement, get it, due diligence completed. There's environmental tests and, lease reviews and a lot of things that go into that due diligence, where we help our clients and we shepherd them through that process as if it was our own asset that we were buying. And I think people like that, because I try to look at it as if I was doing it and what would I do.
Well, let's dive into that process a little bit, because I'm super curious on, first of all, trying to identify 3 pieces of property that fast. Do you suggest doing this way in advance before you hit that, so you can hit the ground running when you're actually in your time period? Or are you, obviously there's a kind of probably a balancing act, because you don't want to be watching this stuff and spending all this time if they're going off market before your time. So like, how do you balance the due diligence trying to find the properties?
Well, once you've decided that you're going to do this 1031 exchange and you feel comfortable with your team, then the next thing to do is talk about selling your property. So really, I mean, you've decided to do this before you've even sold your property typically. Now, not all the time. That's just what I prefer, because then I get to help the client time this so they're not under pressure. Mm-hmm. But, I had a call the other day from a guy, and he sold his property November 15th. And this is a big transaction. It's it's in Connecticut, actually. And he said, he's got a large gain. Markets have been good to him. And he has to ID by December 31st. Well, okay, thanks. Thanks for the opportunity, because it's over $20 million transaction. The point I'm making is that it's never too soon. We should get involved before you even sell your property, if possible. But it's okay if it's afterwards. I can still be of help. We probably just are going to not have as much time to find the great investment. And it's, again, it's about the replacement property. I go back to that with all my investors. You need to choose a property to replace this with that allows you to celebrate the transaction at the end and, enjoy the upgraded investment property. And so the sooner you can get somebody like me involved in the process, the better.
Well, and like I completely agree too, especially, with that gentleman trying to get it done by the 31st. It's ridiculous. And like, that's a lot of taxes. And, I want to talk a little bit more about the team and like the whole overall cash flow and investment kind of picture, because, there's so, I always say that when you're doing this, it's like almost like in a Rubik's Cube when you're dealing with the taxes and cash flow and your investments, because, a lot of business owners have, call it half their wealth, wrapped up into this business that's been paying for their lease, that they might have been, beefing up the lease payments to themselves or whatever it might be, the things that are possible. So now they've got to take this, call it $1 million and put it somewhere else. So when you're looking at your clients, how do you analyze where to put if it's 3 different properties, what types of properties, how to diversify, and then how you are looking at where the investment goes and then the income that comes out of it? Are you helping them dive into the numbers like that too, or?
Oh yeah. Yeah. And I think that's, again, what makes us, working with a boutique firm like my firm, Titanium Partners, I think very powerful, is that we can analyze every single stage and element of the commercial real estate investment process versus, just going to say maybe a broker or an agent or something like that. We really are real estate investors with you. So, it comes back to the kind of the passive real estate investing game. And most of our clients that are doing these exchanges, they don't want the headaches of tenants, and we call it tenants, toilets, and trash with 3 T's, and I understand that they've worked really hard to get to a point where they don't need to do that anymore. So we do have a management company set up to take care of that as well. In most cases, we don't do the day-to-day management. We hire local property managers in the community that we're investing in, but we provide the asset management services, which means we look after the profit and loss statement every month. We talk through issues with the property manager and the maintenance functions so that, at the end of the day, our investors can be as active or passive as they want to be. But with the passive real estate investment tax laws, there's a lot of benefits to being a passive real estate investor when you're retired.
Can you explain some of those?
Yeah, I think there's really 3 ways to invest in real estate, right? There's private equity real estate, like what I specialize in, where you are the funder. There's what's called a real estate investment trust, which a lot of people are familiar through their, or REITs, and they're familiar through their 401ks or IRAs with REITs, which is really just a stock. It's not any different than buying a stock. And then, there's buying the single building down the street that you drive by every day and you buy it because you like it and it's part of your community. And, there's that type of investing as well. So those are the 3 ways to go into real estate investing. And, they all have their pros and cons, but I would say that the positive to private equity real estate versus the other ones, with the single building example, you're going to do the management and you're going to do the daily, tenants, toilets, and trash. And so most of our investors don't like doing that because it just, they want it to retire. Yeah. Or it sucks. Yeah. It's
well, I mean, a lot of these people go from like running a company with employees and headaches and HR, and that's just switching one problem for the other.
Exactly. Exactly. And in a marketplace that you might not understand. And so some people avoid 1031 exchanges because they don't realize there's options to stay passive, which is really a shame. So that's I think that's one of the positives of private equity investing, like what we offer, versus say a single building where you're trying to do it yourself. And then REITs, again, back to that discussion. Again, I have some great friends that run real estate investment trusts. They're very talented people. They're great at what they do. But one difference between private equity and the REITs, I'd say, is the way that the distributions are handled on the REIT structure. I mean, it's straight up income that you really can't offset with depreciation or, paper losses, if you will. Whereas in private equity, you get a K1 at the end of the year. It might even show a paper loss, even though you cash flowed positive. That's really our goal, so that you can offset your income with depreciation. And with that new stepped up basis in the 1031, most of our investors really enjoy that.
So let's for the people that might not be as tax savvy that are listening up, let's dive in that a little bit, because I think depreciation is a big key part of the before and why 1031 might make sense, and what you're talking about as well, and how some of the straight line math works, because you're keeping the wealth that you built and not getting hammered, when you're doing this transaction. So maybe let's go before the actual exchange, where someone has bought a piece of property and there's all this depreciation that they would be getting taken to the cleaners with. Can you explain that? And then also exactly, we can kind of tie into the afterwards as well.
You bet. Yeah. So that, what's called basis. And that's, if I pay $1 for a property, my basis is $1 in that property. And, if you've owned the property for, 28 years in residential or 38 years in commercial, you've depreciated that full dollar out. And so what the IRS does is says, okay, Mr. Property Owner, when you sell that building 30 years from now, and you've depreciated the thing all the way out, you're going to pay tax on that dollar, on that full gain of that dollar. Whereas if you exchange that dollar into a property that, say, costs $2, you don't realize any of that gain. That recapture of that depreciation doesn't have to happen. It gets deferred. That's why it's called a 1031 tax deferment. And the beauty of that is it gets deferred until death. And then upon death, your heirs actually get a stepped up basis. And so they get a stepped up basis back to that full dollar. So you don't, again, you need to consult your tax professionals here, because every situation is a little different with the way trusts are set up and whatnot. But most of our clients, once they start the 1031 process, they don't, it defers until death. So again, beautiful wealth building tool. You can keep exchanging up. It's kind of like playing Monopoly, where you trade 4 houses for the hotel. But the beauty is you don't have to give 2 of your houses back to the IRS when you go to
right. Well,
get the hotel.
Well, and I think, knowing the fact that you and I are neither of us are CPAs, so we can just talk, hypothetically with some of these scenarios. But, some of the numbers, Brian, that a lot of us talk about, whether it's with our clients or, people that have been on the show. So the whole goal is to have passive income. So if you run the numbers, so let's say it's $250,000 a year that you just want passively. Well, in the business, it's not passive because you're managing employees, you got risk and all that stuff. Well, what ends up happening is the business owner goes to sell their business. They take all the taxes with the operating entity, and then you got the building, which may or may not be included. And that depreciation that you're referring to, what happens is that'll actually sabotage the deal to make it where the numbers don't work, because they're not going to walk away with enough money, because they have to pay ordinary income on this tax write-off that they've been having over the last 30 years. So the income the income that they see right now is going to be significantly less because of the taxes that they're getting paid. So and I don't know if I'm just kind of just going down a rabbit hole here, but if you take, it's kind of that whole $5 million mark. If you could have $5 million liquid, clipping away at 7%, you'll be able to passively take 200, 250. So, but you might not always be able to get that liquid. So then how do we use different techniques like the trust and the advanced estate planning and the 1031s to be able to still produce that $250,000? So let's say where the building's worth like, $1 million or something like that. When you start looking at the different properties, how much Do you have some examples you can give on, if you were to take that $1 million and instead of taking the tax, you roll it into income producing properties and how they could get closer to that 250 because of what the mechanism is that you're using?
Mm-hmm. Yeah, no, absolutely. And I want to circle back to something you said about the 250 because it was a good point. Is that so? Let's say you put 5 million to work. If I'm doing my job right, I should be able to produce $500,000 a year, or 10% or 10 cap rate, we call it. And sometimes again, if the investor isn't as attracted to risk, maybe we're going to go down to a 7 cap. But the point is somewhere between 350 to 500,000 of passive income every year for the rest of your retirement years. If you invested 5 million with us, that's typically what you can expect. Now, the beauty of that is because of your depreciation on the $5 million property, and let's say you brought $1 million in, and you leveraged the other 4, well, the beauty is you're getting a 35% cash on cash return in that example because you're using leverage. And then the other benefit of this whole equation is you get the new stepped up basis of the $5 million property less the $1 million you brought in. So your new depreciation amount, our basis is $4 million. Okay. The 5 minus the 1 that you brought in. So that $4 million, again, depending on what asset you choose to go into, you can depreciate over a 28 or 38 year time horizon. And with hotels, there's even another thing called accelerated depreciation for, personal property, fixtures, equipment, things like that. So, using all of those depreciation techniques, typically most of my investors are wiping out that $350,000 to $500,000, cash flow with depreciation. Not in every case, because everybody's financial situation is a little different, but I do have investors that are doing that. So they're getting $350,000 to $500,000 a year in cash flow for retirement, and they're not getting taxed on it because of their depreciation loss.
Well, and this is where I think the beauty comes into having this whole team approach, which is what we adhere to, you adhere to, and because you can't do all this alone so think about, and you and I were telling some stories about my personal experience with this, but when the whole goal is to get to that 250. And let's say you're walking away, through the operating entity that you sell, you could, whatever, assets, stocks, all these different things as far as the business. But then if you got this building that you're going to literally, if you just do the normal situation, you're walking away with 500 instead of $1 million roughly, depending on whatever it is. You throw that 500 into the stock market and then you could barely pull, 20 grand out of that. Versus being able to potentially leverage $1 million into 5 million and then being able to pull 350 out of that. That's a significant difference of whether you can or cannot sell your business.
Yeah, and again, what's a little frustrating to me is when I hear clients that maybe we didn't get the chance to work with because they did their transaction without kind of knowing about this process or knowing who could help them with the process. And we hear those stories all the time. Even myself, I went through that back in the mid 2000s when I sold those residential homes to get into commercial. I didn't know about 1031 exchanges, so I paid the tax.
Well, and then what's your experience when you're when you put in the big holistic plan into place where, you might throw some of it into the market, you might buy another business, buy some buildings, because the whole goal is to get to that passive income. And then as you're building your net worth, you're going to constantly be having this basis that you may or may not have to pay taxes to. But, and again, neither of us potentially, having the tax, law degree. Right. As the LLM, if the listeners are listening to, there's specific people that'll know this stuff, but you've got the advanced estate planning where there's different trusts that you can throw these into to be producing income for your family for life. So I'm assuming with close to 800 million that you've closed or something like that.
Mm-hmm. Yeah.
How have you experienced, and you get any cool stories where you've seen people, wrap in the estate planning as well?
I do. There's one client I'm thinking about when you're talking about the estate planning, and he actually did not. He was this hardworking guy. I think he's about 78 years old right now, and he's been my client for around 8 years. He was 70 when he sold his business, and he had nothing in place. He didn't have a trust attorney. He didn't have, he had his accountant, but he was kind of frugal. The business owner that watched every dime while he was well, he was making his hard work pay off. And so we did get a trust attorney involved with him right away, because again, that's a different level of help than I can offer, but I realized the importance of it. And, he's now set up his heirs for life. And that process can't be understated. Some people will go into a transaction a little bit leery of the fees involved with, trust attorneys and whatnot. But, this is things you're going to pass down to your heirs and your spouses and all that kind of thing. And all that reason for your hard work could evaporate if you don't use the right trust attorney. So,
well, and making sure that it all goes into, because there's a gazillion different types of trusts and which one's right, depending on all the cash flow and the tax planning and stuff. There was a gentleman on the show called, his name's Todd Ganos, and he specializes in this Ning trust, which is a Nevada trust. And there's so many different ways to avoid, to potentially sidestep that capital gains that you are, that the 1031. So with a combo of all these things, you could potentially build a family generational income producing machine without having to actually sacrifice it. What are where does it not work? Because we've talked about all these really great things and stuff like that. Where do people, aside from the bad, cash and cash numbers that you want to avoid from a bad asset, but like, where does it not work where you would look at someone and say, you're trying to make this work just to avoid taxes and you shouldn't?
Well, the first one is the replacement property. If you can't find an appropriate replacement property, it won't and shouldn't work. So that's the first answer. The second answer I'd say is, some of these properties that are being sold are sold in partnerships. And the IRS says that, the same entity needs to relinquishes the property has to be the same entity that buys the replacement property. And so, let's say you and I bought a small commercial building together 15 years ago, and now we want to, exchange it up. But you want to go a different direction with your money. You're moving to Tahiti. I'm moving to Europe, and we're just we're going to end the partnership and move on. That doesn't work for a 1031 exchange, because the same entity and ownership has to go into the replacement property. And so that can derail people sometimes. There are ways to mitigate some of that. I do have clients that will buy property together and then buy each other out afterwards. But again, it's a situation where we want to have an attorney involved to make sure it's papered right.
So that's a really good point, actually. And I think it's a really good thing to highlight, because a lot of business owners have got their entities set up, whether they're, so we had our Imaging Alliance Group LLC, and then it was Minnehaha with the address, which is the building with its own LLC, which had two partners in it. And so I can understand, I mean, that was perfectly highlighted based on what you just said on like that partnership. But what, so an asset sale versus a stock sale with a business, and the asset sale, all the entities and stuff stay behind. But let's say the stock sale, have you seen that? Because the stock sale, a lot of the entities and the ownership transition to the potential buyer. How have you seen people unwind their building from their business prior, if they're doing enough planning in advance to make sure that they can not get into this complicated situation?
Yeah, no, it's an absolute key. So, you have to, again, hold the property for a year and a day per IRS guidelines. So you should start that process at least a year and a day in advance. And then if you're going to sell it into a partnership, from a partnership into a single entity, or, in that case where you're going to Tahiti, I'm going to Europe, let's sell it to a different entity, a year and a day ahead of that transaction happening. So that can be a pretty simple way of dealing with that situation. And there's other ways too. There's things called reverse exchanges. The reverse exchange, I've done a few of those. They are a little bit more complicated and expensive to do, but that might be where you find a property that you want to go into. And so you identify it before you even sell your relinquished property. And you can do that. That's called a reverse exchange. Same rules apply. You have 45 days to identify it, 180 days to close within that, purchased property. But you can actually purchase a property before you sell your relinquished. Interesting.
So when you're potentially selling and unwinding that with the partnership and everything like that, is there tax situations you need to prep for in order to make sure that, you're not having to, because it's all about cash flow. So you're not having to like, suffocate yourself prior. Is there things that you can do, because you don't want to trigger something that you shouldn't, right?
Right. Yeah, there's a couple of things that have to be done. One, in the purchase agreement, it has to say this is a 1031 exchange. So, and there's a specific legal language from the IRS code that gets used and put in the purchase agreement. Now, the beauty of using, again, maybe let's call me a ghost buyer, right, for my clients, is that the last thing you want to do is tell somebody you're buying a piece of property from that you're in a 1031 exchange situation, because they're going to, obviously you're put at a negotiating loss right there. Right. They know that you have a certain amount of time or you're going to pay tax, and
they could overcharge you because they know what you're saving.
Exactly. And do most of the time you're going to overpay if you let somebody know you're in a 1031 exchange. So that's where using a boutique firm like mine and as a ghost buyer can really benefit the negotiating position. Once we have it acquired though, and under purchase agreement, and the terms are basically agreed to, then make sure it's papered up right with the clauses that it is a 1031 exchange in the legal documents. The accounting process gets a little interesting in, let's say that the timing it's December of 2017 and we've just sold our property, right? And we're going to replace that property, but we've got 6 months to do it. So we're not going to replace it until end of May of 2018. Well, most people want to get their taxes, filed or have to by April 15th or, March 15th, depending on their situation. You can't file your final tax return until your replacement property is finalized and completed. So we do watch that for clients, and usually, a good CPA is going to catch that too. We have had instances where, not in my side of things, but with clients that get us involved late in the process where they've, filed their tax return before they've closed on the replacement property. And, it's the IRS gets it. This is a complicated transaction. And usually what they do is they allow you to amend your return as long as you'll pay their taxes and penalties and fees. So
as long as you pay them, right?
Yeah, then they're fine with you amending your tax return. It's kind of interesting how that works. But in reality, they want you to follow the rules too. And, sometimes there's folks that will go ahead, file that return, and the replacement property is not completed. So that, if anything can go wrong with the accounting side, it's usually that I see. The rest of it's really straightforward. I mean, it's, the unfortunate part is a lot of accountants, especially in smaller markets where we're seeing a lot of these businesses trade hands now, in the tertiary and small markets, you might not have dealt with this before as an accountant. You might have been in business for 35 years and maybe you've heard about tax exchanges at the continuing ed seminars you went to, but you've actually not ever seen it. And it's scary for you to recommend this to your clients. And that's unfortunate because the process is really straightforward from the accounting standpoint.
Well, and I'm going to reiterate a point you just made, Brian, is so that, I think that the professionals that are involved in any kind of business transaction or a transaction like this, they should be the ones that are doing it all the time, because you can't have your CPA that knows how to depreciate a rental furnace, 7 ways a Sunday, but has never done this before, because it's a specialty. And, you wouldn't want to go to the hip doctor that's done one before. You want to go to the one that does 40 a day. And whether it's the estate planning, the tax attorney, the 1031, all that stuff, it's too important, and it's too big of a financial decision to leave it up to chance that someone's going to, it's a lot of risk for them to put their foot out there if they've never experienced it before.
Oh, for sure. And, I do this in life too. Like you said, you made the example of the doctor that, does the hip, and let's say you need your knee done. We can't be experts in all things, even though we were pretty good at our businesses. So I really recommend that people, seek out the right help and find somebody that you feel is trustworthy. This is a big transaction for you and your family. And, you want somebody that you connect with. I always tell people in our firm that we're going to speak Midwestern. No offense to my coast friends and clients, but pick somebody that you're comfortable working with is what I mean by that. And and
avoid the passive aggressive part of the Midwestern though, right? Get someone that doesn't have an ego, but that's willing to at least speak their mind in front of you.
That's a great point. Yeah, like the guy that called me and said I have till December 31st to protect a $20 million gain. Yeah, I went passive aggressive on him. I did.
We can maybe do that. No, you're an idiot, dude. Come on, like you should have been planning ahead.
Yeah, thanks for the opportunity, but
well, so Brian, let's, as we're wrapping up here, let's tell that story about that client of yours that with the Hawaii, because it's just too good of a story that shows what's possible with this.
Yeah, and this is why I do what I do for a living right here, because it's just so fun to celebrate after the replacement property has been secured and our clients, we have some testimonials that I know you're going to share my contact info afterwards, and I'm happy to share some testimonials. And whether your listeners use me or not, I hope that they use the 1031 exchange because of this story. So I had a couple approach me, and they worked hard. They had a screen printing business actually, but luckily their business was located in a building that over their holding period of 25 years, everything around them grew up, and it was in an urban environment. And so their building, I think their original basis was like $200,000 or $300,000 in this property. So very low, and it pretty much had all been depreciated out. And they had a developer approach them because they needed the property for an accumulation, and they were offered $1.8 million for the property. Well, they went in with their accountant and said, if we sell this for 1.8, what are we going to pay tax on? Well, we're going to pay tax on the 1.8. All right. Is it worth us selling? Because right off the bat, we're left with 900,000 basically. And then, what do we do with that? So they got a hold of me through a referral, and we started the process early, even before they sold, looking at properties. And we probably looked at, 30 off-market properties for them to go into before they picked the one that they wanted to. And at the end of the day, we found them a multi-tenant retail office building, completely hands-off. They're in their mid-50s now, and were able to move to Hawaii, which was their goal. That $1.8 million transaction, and maybe their business had produced 100 to 200,000 a year at their peak. This wasn't a big business deal. This is your relative down the street, that you wish good for all the time, but it doesn't always happen to them, right? So this couple, they sent me a picture last month, and all I saw was their feet in the ocean in the background, and they said, thanks, Brian, we couldn't have done it without you. And that was so powerful to me. It was like, yeah, that's what it's all about. They worked hard. Now they've got their feet up. They're in their 50s and can enjoy their dream place. And, in that example, they put the whole $1.8 million to work. They didn't have any debt, so we were able to buy them a $3 million property. And it was, we found something that was around an 8.5 cap. So their income before taxes is right around $150,000 a year. Well, that's great for these guys. That's what they were working hard on before to produce, and had to work 8 hours a day, both of them.
Well, and let's go into that, because in order to get $150 a year, you need about $4 million in investments in the market. So they would have only had 900 had they not done this. So they would have been able to pull maybe 35 grand out of that. So they went from 35 grand to 150. I'd say that's pretty much life changing.
Well, the big difference there, Ryan, is leverage. If you're looking at the benefits, and I wrote an article on this, I'm happy to share with you on the benefits of real estate versus stocks and bonds. Sorry, financial advisors out there, but I think I kick your butt every time. and the reason I do is a little unfair. It's because banks are willing to let me leverage my cash. And sure, you could do a margin or account or something like that with stocks, which is extremely risky. But in my case, we're going to take on acceptable levels of debt, 75% loan to value or lower. And you're going to put your money to work plus somebody else's, so that you can leverage and get that $150 instead of 35,000. And that's, where else can you do that?
Well, it's a big deal. And I think, I don't know if in your investment scenarios that you're running is, because I think the biggest question that anybody would have is, okay, well, what happens if the real estate market takes a shit and then I can no longer, I'm now got all that debt, I've got all this risk into one piece of property or maybe three. I'm assuming you run the scenarios that says, okay, what if we go to 50% vacancy, because it's less irrelevant on that. If that 3 million goes down to 2, it's more about the cash flow, right?
It is. Yeah. And that's when people ask me what I do for a living, that's my response is I find cash flow. So, everything goes back to the underlying asset, back to that risk reward discussion that we first have the first day I meet with somebody. And, what's their risk tolerance? If something goes wrong, and let's say it goes 100% vacant, can my client afford to carry that asset cost until I can put a new tenant in there and re-tenant it, or the market's recovered or something like that? And typically the answer is yes. I do have some clients that are not risk adverse that will go with 100%, vacancy scenario and say, I'm still going to do it because, I've got enough cash flow that I can ride the market out if I need to. But that can happen. And we did see that happen a lot in 2008 and 9. And one of the reasons that happened with debt is we had some financial institutions that were calling notes due because there's something called a debt service coverage ratio, DCR. And your DCRs a lot of times have to be 1.2 or above, which means that your cash flow equals at least 1.2 times the debt. So we watch those parameters pretty heavily now, whereas pre-recession, people were doing things with negative debt coverage ratios.
Yeah.
So, we're pretty careful with our clients and with the banking. Again, the other team member that we didn't identify is your banker. We get them involved right away too. And they love 1031 exchanges. They absolutely love the process because they know that they're going to get, increased loan values.
Because the banker is going to make a $4 million loan. You don't think he's going to be happy about that?
And 10 years from now, he knows we're going to do it again, and he's going to get a $10 million loan. So it's a great process for bankers that love it. But they're very cognizant of loan to value ratios and debt service coverage. So I'd say those are the two things that we really watch with our investors and their team member, the banker.
Well, I think it's important as we're looking at the main thing is cash flow. And a lot of owners have a struggle to look to how do they unwind from their business, whether it's the operating entity in the building or whatever that's outside, and saying, how can I produce cash flow that is equivalent or less risky than my business? And, I think seeing a way out is the most important part, that you don't have to just, sell to, hire a broker and sell everything and then just be SOL. But there's a lot of things you can do to significantly, see a clearing to get yourself out of the business without taking a huge hit.
Oh, for sure. No, and this is, you hit on the Nevada Trust discussion. The 1031 exchange is one of the things out there. The Nevada Trust is another good tool to use. There's also, the Delaware Statutory Trust that a lot of our clients use. And so, there's a lot of tools in the toolbox that we have access to. It's just, you kind of have to be comfortable using them, and you have to be comfortable that you have the right team helping you through the process. And
have the right blueprint, because you use all the tools for specific things within the grander plan.
That's right. And that's probably where your trust attorney comes in, and I think a lot of the services that your firm provides too are excellent. So, it's all part of this team, and that's what makes it kind of exciting. When you get the right folks on your team and using the right tools, that's how you get that picture of Hawaii with the sand in your toes. Right? And, yeah, and when it's cold out right now, that looks
the opposite of where we are at.
It's true.
All right, Brian, what's the best place for our listeners to get in touch with you?
I'm pretty accessible. They can call me anytime. I love what I do, and so I'm always willing to take calls from people that are interested in this process, and help them identify if it's something good for them or not. So calling me is the best way. And you can reach me at 218-590-8205. Again, 218-590-8205. That's my mobile phone. And feel free to shoot a text out or call or anything. Like I said, I love this subject matter, and I love working with people with questions.
And if you're trying to close a 1031 within 2 weeks before the end of the year, he's all open.
Yeah, exactly. There's absolutely nothing going on at the end of the year. But in seriousness, I'm willing to talk to those folks too. So let them call. I don't know if I can be helpful, but probably on the next transaction.
Right.
Yeah, or by email, Ryan, too. And it's B Forcier, Forcier, at Titanium Partners, plural, LLC.com. We also have a great website. You can check us out there. My bio sheet's out there. Some of our previous work is out there, so you can check us out.
And I'll attach all that stuff to the show notes, too, for the listeners. Yeah,
that's great. Thanks. And it's titaniumpartnersllc.com. So love to hear from folks that are interested in the process. And it's like I said, one of the greatest wealth building tools that we have left.
I love it, Brian. Thanks so much for coming on the show.
Thanks, Ryan. Appreciate it.